Imagine waking up to find one single institution controls pieces of the technology you use, the bank you trust, the airlines you fly, and the pharmaceutical companies making your medicine. This chart shows the scale of that reach. At more than $11 trillion in assets under management, this entity holds a figure that eclipses the annual economic output of almost every nation on Earth, surpassed only by the United States and China. Its name is BlackRock. And because its name appears on the shareholder lists of thousands of multinational corporations, a popular belief has emerged that they secretly own the globe. But they actually don't own most of these assets. The capital belongs to someone else entirely. To understand how an institution acquired such vast influence without outright ownership, we have to look at how modern finance was rebuilt from the ground up. In the 1980s, Wall Street was moving faster than its own math. Banks were rapidly inventing new financial products, bundling loans and selling them to investors. The system was highly profitable, but almost no one actually understood the underlying risk. Larry Fink was thriving in this environment. As a young banker at First Boston, he helped pioneer the mortgage-backed securities market, developing new ways to package home loans into complex investments. Then, his department made a single incorrect prediction about interest rates. In one quarter, they lost nearly $100 million. Fink's reputation collapsed. That massive loss forced him to ask a different question. What if a firm could accurately measure financial danger before it happened? In 1988, he and 7 partners founded BlackRock with a very specific thesis. They decided to focus strictly on analyzing risk, trusting that profits would naturally follow. At the time, most investors were still making decisions based on basic spreadsheets and human intuition. BlackRock took a different approach, building computer models to assess probability, economic shocks, and inflation from every possible angle. They built Aladdin, a sophisticated software system monitoring millions of investments, pulling data from stocks, bonds, and real estate into a central hub. It became so robust it routed that analysis back out. Today, major banks and even competing firms rely on Aladdin. Before it amassed its trillions in managed capital, BlackRock established its position by becoming the risk management operating system that large parts of Wall Street depended on every day. The true test of this system arrived in 2008. When global markets crashed, many of the world's largest banks collapsed because they had completely lost track of what assets they actually held. They lacked the internal tools to measure their exposure to toxic loans. Facing a total breakdown of the system, the U.S. government and major financial institutions needed a firm capable of parsing the chaos. They hired BlackRock to analyze and untangle the massive webs of failing assets. Exiting the crisis with immense credibility and new capital, BlackRock made a major acquisition in 2009. They purchased Barclays Global Investors and its iShares division, pivoting aggressively into the exchange-traded fund market. This marked a widespread shift toward passive index investing. Instead of paying active managers to guess which companies will succeed, investors purchase a single fund, buying slices of the entire market. The combination of their proprietary risk technology and their dominance in low-cost index funds turned BlackRock into a highly efficient vehicle for capital. Trillions of dollars rapidly flowed into their management. Today, you will find BlackRock listed as a top shareholder in Apple, Microsoft, major oil producers, and large healthcare providers. But the shares in those index funds do not belong to Larry Fink or his executives. The true economic owners are everyday individuals, teachers contributing to their pensions, firefighters paying into union trusts, and ordinary workers saving for retirement. Every month, millions of automated, small-scale investments are routed from paychecks into funds that BlackRock happens to oversee. BlackRock acts as the structural bridge. They execute the trades and manage the portfolios according to strict fund rules, but the actual capital and the financial returns it generates belongs entirely to the public. However, managing those shares creates a different kind of leverage. As the representative for millions of investors, BlackRock holds the proxy voting rights for all of those combined shares at corporate meetings. This massive block of votes allows them to weigh in on executive compensation and board of director elections, and the long-term strategic direction of the largest companies in the world. Because that influence spans nearly every sector of the economy, their voting decisions are scrutinized heavily. They receive intense criticism from across the political spectrum over how aggressively or how passively they use this centralized authority to push corporate agendas. Operating in over 30 countries and managing more than $11 trillion, the firm effectively functions as a central nervous system for global capital. They achieved this scale by turning financial risk into measurable data and making themselves indispensable to the broader market. The story of BlackRock demonstrates that in modern finance, you do not need to own the world's wealth to hold immense power over it. You just have to manage it.